Hello, welcome to America First Wealth Management Investment Outlook for Monday, December 16th, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. This is our standard disclaimer. We're not offering any investment advice here or any offer or solicitation to purchase or sell any securities. These are solely our opinions as of December 16th and are subject to change without notice. So we would like to begin and talk about our market outlook first for the week, and we'll follow up with some additional information, which hopefully our viewers will find of interest. So last week we had higher than expected November PPI reported. It was 0.4% versus a consensus of 0.2, so it was a hotter than expected producer price index, but we still expect a 25 basis point rate cut this week, and we're looking for a Santa Claus rally through year end. Big news happened today. Trump, the deal maker, he got a deal for SoftBank to invest $100 billion in U.S. projects to create 100,000 new jobs in the U.S. Also occurring last week was China was contemplating weakening its currency in response to Trump tariffs. We'll talk a little bit at length about this and why they might be considering that. And also we're going to talk about a sector that, particularly the industry, oilfield service, which seems to be unloved but is doing very well economically, could be interesting in 2025 as a cyclical area of investment, especially since everyone is chasing growth and momentum names right now. Looking for value and good fundamentals could be a good area to look for next year. In terms of key macro data points this week on Tuesday, 9:30 a.m., we have retail sales month over month. Wednesday will be preliminary building permits number. At 3 o'clock, the important Fed rate decision, like I mentioned, we're looking for a 25 basis point rate cut. And following that at 3:30 will be their press conference. Thursday, 9:30 a.m. will be GDP growth rate. And Friday will be core PCE, personal income, and personal spending. We have a handful of key S&P 500 company earnings this week. General Mills, Jabil, Lennar, Micron. I'm not going to run through all the names, but you can see there are some key bellwethers we want to take a look at. FedEx and Nike on Thursday, for example. And let's go on to the next slide. So all eyes are on the Fed's last policy meeting of the year. And as this shows, with the CPI inflation and PCE inflation trending downwards despite a slight uptick recently, the Fed funds target rate does have room to fall. And everyone is looking for a 25 basis point cut. And we're probably going to expect Chairman Powell to talk about the economy is in decent shape, and that might moderate the pace of further rate cuts or a potential pause as we start in 2025. So there shouldn't be any surprises there. We do expect the markets to continue their rally through year end, certainly in celebration of the successful election of Trump and also all the announcements that he's been making. And certainly this announcement, as I just mentioned, Trump and SoftBank announcing that they're going to invest $100 billion in U.S. projects, resulting hopefully in 100,000 jobs. And for those of you who might remember, in 2016, SoftBank did announce an investment of $50 billion in U.S. and anticipation of hopefully creating 50,000 jobs. Some of that was hindered by COVID, but nevertheless, it was still a substantial investment at the time. And this announcement today is a further big deal that Trump was able to successfully bring to fruition. Turning to China, Reuters had broken a story saying that Chinese authorities were considering a weaker yuan as Trump trade risks with tariffs were tightening. You can obviously expect the Trump administration to accuse China of being a potential currency manipulator. But China needs to do things to stimulate their economy, as their economy is facing some softening pressures. And we can see that the imports of trade goods from China has risen dramatically from 1985 to 2023. It has dipped in recent years, and China is certainly feeling that pain, and that's certainly understandable. I mean, China is a huge manufacturing machine. You can see what they've done to the automotive market in the last 20 years. They've gone from a 1% market share in total cars produced worldwide to a whopping 39% market share. And that's come on the backs of market shares decreasing for Europe, Japan, and especially in the US. You've seen the US market share drop from about 14% down to 3% of global uh, world market share production in autos. So understandably, Donald Trump is angry about that, and he wants to protect American manufacturing industries and try to use tariffs to get prices to more of a level playing field. This chart shows China's exports of goods and services as a percentage of GDP, which is approximately 20%. So that's a pretty high percentage of GDP. China does need a lot of its GDP to come from exports. Comparing that to US, US is only about 11.63% export in terms of component of their GDP. In the US, services are the highest portion of GDP. And why does Trump say drill baby drill? I think this table explains it. These are US exports 2022. You look at refined petroleum, crude petroleum, and petroleum gas, that works out to about 19% of total exports come from energy. So when Trump says drill baby drill, I'm sure he's aware of the importance of this as the export product, and obviously lowering energy prices would have an effect on reducing inflation rate domestically as well as globally. Would also have the benefit of improving the exports on a total basis. Even if oil prices do drop a bit, if we're able to produce more and export more, that would have a benefit to the exports in for the US. Turning to the oil field services sector, as I mentioned, I like the fundamentals. You can see for the last 3 years, the oil field services sector has become profitable on a net income basis. And that's probably the benefit of higher CapEx spending, which is now leveled off. And when CapEx levels off, you typically see an improvement in cash flow, and that goes towards things like paying down debt, which we've seen, and enhancing shareholder returns. At the same time, this chart shows the VanEck Oil Services ETF versus the S&P performance for the last 5 years. The Oilfield Services ETF is in blue. S&P is in the lavender color here. You see the S&P has taken off, whereas the Oilfield Services ETF is lagging considerably. So being certainly a cyclical industry, if we do see energy prices increase, and given the fundamental improvement in the health of the companies, this could be a dramatic improving sector slash industry. In the past, for those who follow the markets, oilfield services has had its periods where it's been the best performing industry, and we would expect the same to occur, especially if we saw energy prices starting to increase. Um, this is crude oil prices. Obviously, it's been down, and one may wonder, uh, would it continue to go down uh, if the U.S. decides to drill more? And the answer is possibly, because uh, oil prices are not solely determined by the U.S. production, it's also determined by foreign production, OPEC countries, and they may decide to curtail their production significantly to maintain oil price strength, or even to increase price of oil. And certainly, if there is a global recovery in the economy, um, we are going to see higher demand. So it's not a singular component that drives crude oil prices. Um, it's a multitude of factors, and it's too early to predict. I would say just watch the price. If the price rises, that will lead to a benefit in the oil services industry. Also, natural gas is important to follow, and we're seeing certainly an improvement in natural gas prices. And if we do have a cold winter, that's going to have an impact on natural gas prices. Turning over to weekly market stats, last week markets were mainly down with the exception of the NASDAQ 100 and 1000 growth indices, largely because of the PPE number, which did result in a spike up in interest rates. As you can see, the aggregate bond ETF was down 1.42 for the week. Value stocks got hit, international stocks got hit, and small caps got hit. For the year to date, though, there should be no complaints. It's been a very strong year for the stock market averages, and most investors should be pleasantly pleased when they look at their stock accounts and 401ks and IRAs, which I think will spur consumer demand and a good mood certainly as we enter the new year. Looking at the Magnificent Seven names, Tesla continued its torrid increase in share price, especially post-election. You can see it was up over 12% last week. Up the leading stock for the quarter, quarter to date, up 66.7%. And we're looking at Tesla to certainly possibly move into second place behind NVIDIA year-to-date performance. We only have about 2 weeks left in the year, so it will be a race for number 2. And we've no doubt Tesla will continue to achieve this, even though it's hitting record highs in its share price. Elon Musk made the big bet to align himself with Donald Trump, and he's certainly reaping the benefits of it with his fortune being compounded almost daily with Tesla's share price rising. Turning to U.S. sector performance, consumer discretionary stocks the only sector that was up during the week. Consumers are spending as we go into the holiday season, obviously, and those shares in consumer discretionary were the only strong performer for the week. The rest of the group is pretty much down, and we are recording this Monday evening. We're seeing a dramatic turnaround this week as we do anticipate as we look towards the optimistic rate cut on Wednesday, but certainly the news coming from Trump with the $100 billion deal with SoftBank certainly is a nice catalyst for sentiment as well. The S&P 500 post-election has flattened out a bit here. Had a nice run up since the election, so it should not be unexpected for a little consolidation here before we set a new direction up or down. I think I mentioned this last week, the RSI was kind of extended for the S&P 500. So a pullback here, a slight correction should be expected, but there's nothing that suggests that we are entering a period of bearishness. This is a normal consolidation and a strong advance, we believe. And we do expect a Christmas rally to continue, hopefully beginning this week. 10-year Treasury yields did pop 25 basis points for the week on the backs of the higher PPI number. So that had an impact of the rates popping above the 10-day moving average, which is a bearish signal, of course, for the yield trend technically. But do bear in mind that we do have the FOMC meeting on Wednesday, and this could sharply reverse, as we do tend to see sharp moves against the trend can quickly turn after an event like the FOMC meeting or significant data on inflation. The yield curve, you can see the top line represents last week, which did move up sharply against the prior week. So that is negative for interest rate sensitive sectors. But we'll wait for the story on Wednesday in terms of what the Fed does and what their outlook is going to be. Turning to economic calendar, I'm not going to dwell on these, just to point out that the red ones are the critical ones. Retail sales on Monday, we're looking for 0.5% retail sales month over month versus previous of 0.4%. The Wednesday building permits and the Fed interest rate decision. Fed interest rate decision, we're looking for 4.5%, dropping 25 basis points from 4.75. Thursday is GDP in the morning, 9:30. Friday will be some inflation, income and spending numbers. So a very busy week in terms of macro data points. We do net believes we will end up higher, and we'll see how it goes. Earnings, I won't dwell on these, as I kind of mentioned who will be reporting, and I'll just let this stay up here for a moment so any viewers can look at the consensus versus a year ago and the consensus revenues. Here they are. And if anyone would like a copy of this, please reach out to us. We'll send you a copy of the presentation as well. This is Friday. And here's our contact information. If you'd like to get a copy of the presentation, reach out, set up a meeting, or ask us any questions. Feel free. We're always happy to talk to any of our investors or prospects. or anyone who just wants to talk about the markets in general, we are here. And if any financial advisors would like to sign up to receive our outlooks and updates and any information, please go to www.americafirst.fund to sign up and receive more information. Thanks for tuning in and have a great week. And we'll look forward to you next week. And have a great week investing and be careful out there as the weather gets colder and some parts of the country are getting wet and slippery and cold and rainy and icy. So happy investing, happy shopping, and safe travels, everyone. Take care.